So let's talk about taxable income and how we arrive at it. So with individuals, we had this whole concept of adjusted gross income. We don't have that with corporations. We don't have that with partnerships either. But remember, partnerships are flow through. So it's once it flows through to the partner's tax return, then they have adjusted gross income. But for corporations, we never talk about adjusted gross income. It doesn't even enter into the conversation because C corporations are not flow-through entities. That means they pay tax, just like individuals. So none of the income or expense items flow through to the owners of the corporation, of the C corporation. None of that flows through. The corporation itself is going to pay taxes on its net income at its own tax rate. Okay. So how do we calculate that? It's kind of, in some ways, it's kind of similar to how we calculate it for sole proprietorships and for partnerships, but there are a couple of items that are a little bit different. So total gross receipts or sales minus cost of goods sold, that sounds familiar, right? And let's take a look at the form. So here's our gross receipts minus our cost of goods sold. And again, we would have a cost of goods sold calculation. There we've got a schedule for cost of goods sold. So that is the same to arrive at our gross profit. Then, now this is where it's a little bit different. So remember, with the partnerships, we had all our interest and dividends, capital gains, all of that stuff was not included on the front of the return. It was part of that Schedule K because those were separately stated items. Well, for corporations, we don't have ordinary income and separately stated items. Nothing like that. All of that income is included in gross income. It's included as income, and it shows right here. So interest, gross rents, royalties, there's no special treatment for those items. There's no special tax rates for any of those items. There's no special, we got capital gains, we got no special tax rate for capital gains for corporations. Their tax rate is the same as their ordinary tax rate. So we don't have to separate that stuff out. We can include it in our total income. And then we have ordinary and necessary trade or business expenses. So again, ordinary and necessary. Now, one difference is from partnerships, we've got compensation of officers. Officers can be, and shareholders can be employees. So remember, for partnerships, they can't be employees of the partnership. But owners of corporations can be employees of that corporation. So they would get a W-2 just like any other employee. Okay, so that's another difference between corporations and partnerships. So we subtract out our ordinary and necessary expenses, and then we get taxable income before special deductions. Okay, these special deductions are these are different for corporations than they are for individuals or partnerships as well. A couple of them: net operating loss deduction, which I think we talk about somewhere. Yes, we're going to talk about that down there. So we have a net operating loss deduction, which we'll talk about. And we've got this dividends received deduction, which we will also talk about. This only applies to corporations. You don't see this anywhere else, this dividends received deduction. And I'll explain what it is and why corporations get it and the rest of us don't. To get to our taxable income, multiply that by our applicable tax rates. Tax rate is 21%. That's it. It's a flat 21% now for corporations. to get to our tax liability, and then we're going to subtract, just like with individuals, any payments that were made during the year and any tax credits that may be due, and work to arrive at the tax due or any refund that should be received. Okay, again, AGI does not exist for corporations. Doesn't mean anything. The taxable income follows the same trade or business rules that were discussed in Chapter 6. There are a couple differences: capital gains and losses, charitable contributions, and this dividends received deduction. And there are some other small differences as well. We're going to look at all of those. Okay. So that's the general calculation, and of course it follows the tax return, right? So it follows the format of the tax return right here. Okay. So first, let's talk about capital gains and losses. So remember, we had for individuals, you can take that $3,000 up to $3,000 of net capital losses, right? That's what individuals get. Corporations don't get that. They don't get any loss. If they have a capital loss, it carries forward. They don't get to take. It doesn't get to offset any of their income in that year or in any year. Well, it can offset other capital gains in future years, but there is no $3,000 or any amount of capital loss that is allowed for corporations. So they don't get that benefit. It's just, and there's no special tax rate either. So it doesn't matter whether it's short term or long term for corporations. It's just all the same. So in that respect, that's a lot easier, isn't it? That's a lot easier than what we had to deal with regard to the short term, long term netting, all that jazz. So that's one difference. So they can also carry back capital losses for up to 3 years. So not just forward, but you can go back with them, starting with the earliest year and then forward for 5 years. So those are their limits on capital losses. We'll look at this example here. So we've got ABC Company, formed in 2016, had net income in each year of its operation. So that means they wouldn't have taken any loss in any year that they had a loss, any capital loss. Well, they wouldn't have taken one anyway, but they had net income each year. So this $21,000 loss, well, what that means is this loss can't offset any negative income. We can take it back 3 years though. 1, 2, 3. So we'll take $10,000 and offset, go back and we'll amend the 2018 tax return. And we'll get probably a refund because we can offset that $10,000 gain. And then we'll go and we'll amend the 2019 tax return. And we will offset, let's see, ABC, total capital gains. Trying to see here, yeah. Okay, and then we'll offset the $1,000 gain in that year. So now we're down to $11,000 left of our 21. So we got $10,000 left. And then we will offset, we'll amend our 2020 tax return and we'll offset that $5,000 gain. And these are capital gains, by the way. It's not going to offset other gains. It doesn't offset other income. You've got to have capital gains. And then we'll offset that $5,000 gain in 2020. And then we've got $5,000 to carry forward, and we've got 5 years to carry it forward. Okay, so let's take a look at this one here too. So we've got Pirate Company, formed in 2016, reported capital gains and losses prior to any carry forwards and carry backs as followed. All right, let's take a look at this. So 2016, they had a $2,000 loss. Well, they can't take that loss. Let me see if I can do this. They cannot take that loss in 2016, right? And they can't carry back because they didn't exist. So what they can do, though, is they'll carry it forward to 2017. So they've got a 2017 loss. Let me see if I can get I'm going to get Excel spreadsheet up here. All right, we'll put it right in the middle. Right there. Okay, so for 2016, oops, they've got a $2,000 loss. 2017, $7,000 gain. So what we're going to do, they can't carry that 2,000 back, but they can apply it to 2017. So now their gain is $5,000 in 2017. And then in 2018, they got a $10,000 gain. 2019, they got a $16,000 loss. Whoops. All right, so first we're going to apply 5,000 of that 16,000 here. So now we've got a 0. We're to 0, but we've absorbed 5,000. So now we're going to apply 5,000. I'm sorry, 11,000. Whoops. But we can only apply $10,000 to that. So now our net income for 2018 is 0, but we've got 1,000 left. Right? So we can carry that forward. 2020, we had a $5,000 gain. We're going to apply that 1,000. So we have a 0. So this essentially, we've zeroed that out. Oh, sorry. We've zeroed out so we've absorbed all of that 16,000. Whoops, sorry. This should be 4,000. So our income, or our gains, now, whoops. 1,000. 1,000. Right now we're at 4,000, but look, we've got another loss. In 2021, we've got a $14,000 loss. Well, we absorbed all of that $16,000 loss, but now we can use 4,000 of this we're going to apply over here to get to 0. Whoops, wrong box. I hope you all can see that. Okay, so we have remaining $10,000 loss that we can carry forward to future years. Which is right there. Okay, so you've got it. You can look back and you can look forward for all of that. But you essentially zero everything out as much as you can, going back first. And if there's nothing you can, zero out from the past, then you go forward 5 years. So back 3, forward 5. Okay. You file an amended return and receive a refund if you're carrying it back. Okay. As I mentioned, so tax rates. Corporations' net capital gains are included and are taxed at the regular corporate rate. There is no special tax rate for capital gains. No short-term, no long-term, none of that. All right. Next up, Charitable contributions. Okay, so charitable contributions, corporations can make charitable contributions, but they are limited in amount. So the deduction is limited to 10% of taxable income before any charitable contributions, before any dividends received deduction, before any net operating loss carryback, which we're going to take a look at, and before any capital loss carryback. And then they're limited to 10% of that. Any contributions in excess can be carried forward for 5 years. They're added to the contributions that year subject to the 10% limitation. It was increased. Now be careful, because some of your problems, because it's 2021, they increased it to 25%, but it was only in 2020 and 2021. Okay, so here we've got Szabo Company. Reported $50,000 of taxable income before any charitable contributions. Let's get this up here. Let me use this again. Whoops. Okay. Wonder if I can a little better for you guys. All right. So they reported $50,000 of taxable income before any charitable contributions. They had charitable contributions of $8,000. They are limited to 10%. $50,000 is their, where'd it go? Is their limit, which is 10% of the 50,000. So in this case, their taxable income will now be $45,000. Charitable contributions carry forward is $3,000 because they didn't get to use $3,000 of that $8,000. So if it were 2020 or 2021, I guess I didn't need this. If it were 2020 or 2021, they would get to take $12,500. So in that case, they would get the full $8,000 because it's less than, obviously, less than the $12,500. So it's going to be whichever's less, the actual contributions or 10% of the net taxable income before any of these items. So you'd have to add back any of those. But for 2021, use 25%. Okay. Also, if the corporation contributes ordinary income property, then the basis is, it's limited to whatever their basis is. So inventory items, that's anything that would generate ordinary. Of course, for corporations, it's all ordinary income. There's no special income. There is no carryback information. It's only carry forward for 5 years. Questions about charitable contributions? All right. Next up, dividends received deduction. Okay, so you guys have heard of the concept of double taxation, where corporations are subject to double taxation. I don't know if you've heard of that before or not, but it has to do with dividends. So corporations pay out dividends to their shareholders, which is just essentially money that they have, extra money that they have in retained earnings, right? That they distribute to shareholders. Shareholders like to make money. So corporations will use dividends as a way of encouraging people to purchase their stock, because if they pay a lot in dividends, they'll get more individuals wanting to buy their stock. So that's why they pay dividends. But the problem with dividends is they are not deductible. They do not reduce taxable income. So they're not included in any of these expense items. Dividends aren't an expense. They're not a deductible expense. So what happens is, if they're not included in here, they don't reduce taxable income. So that means that essentially there's no tax benefit to the corporation of paying dividends. But when they pay those dividends to shareholders, shareholders now do have to pay tax on them. So essentially it's been paid, the tax has been on those dividends has been paid at the corporate level, and then it has also been paid when it was at the individual or shareholder level. So that income has been taxed twice. We've seen that in most cases, something that is considered income to one party is a deduction to the other. For example, when companies pay employees wages, those wages are taxable to the employee, but they are deductible to the employer. So it doesn't get taxed twice. Well, same thing does not apply to dividends. They are taxable to the shareholder and they are taxable to the company. So they're taxed twice. In order to address that, at least a little bit, they have this dividends received deduction, which means that corporations that receive dividends will, depending upon their ownership percentage, will get a deduction related to those dividends. So the table here shows what the ownership percentage is. So if the corporation owns less than 20% of the other corporation, and they receive, let's say they receive $100 of dividends, which they have to report as income, they will then get to take as a deduction 50% of that. If they own 20 to 80%, they'll get to take a $65 deduction. If they own 80% or more, they get 100%, $100 deduction. So in that case, it's not double taxed. Okay, so here we've got Duck Corporation. They own 25% of Rose Company. That's between 20 and 80%. They received a $10,000 dividend from Rose. They're entitled to a $6,500 dividends received deduction. That dividends received deduction is what goes here. So, and you can see dividends from a less than 20% owned domestic corporation. Here, 20% or more here. And the 100% isn't. Oh, here we go. Dividends from wholly owned, well, that's wholly owned foreign subsidiaries. Dividends from domestic corporations received by dividends from affiliated groups. One of these 100% ones is the 100% owned. So that's where that so for here, for Rose Company, so they would say, yeah, we got $10,000 of dividends. We're going to multiply it by 65%. Now we get a $6,500 dividends received deduction. We would enter it here. Enter here on page 1, line 29B. So we get to deduct that, the $6,500. But up here, dividends, we had to claim $10,000 of income. So it helps to reduce that. So it can be limited if taxable income before the dividends received deduction or any capital loss carryback is between 100% of the dividend and 50% of the dividend received deduction is limited to taxable income multiplied by the appropriate percentage. Okay, so what the heck does that look like? Here we've got Silva Silverware, these names, owns 30% of Fredonia Flatware. Fredonia paid a $20,000 dividend to Silva. Silva's taxable income before the dividend received deduction was $50,000. All right, so $20,000 times 65% is $13,000. Now, same information, a little bit different. Silva's taxable income before the dividends received deduction is only $5,000. then their taxable income is not between 65% of the dividend and 100% of the dividend. Therefore, the dividends received deduction is not limited. Using the same information, let's say it was $18,000. In this case, Silva's taxable income is in the limitation area between $13,000 and $20,000. Therefore, their dividend received deduction is limited to 65% of taxable income before the dividends received deduction, or $11,700. Okay, so it's so what you do is take 65% of the dividend and 100% of the dividend, and if the income falls between those two amounts, which in this case it didn't, but in this case it did, then you take 65% of the actual income rather than 65% of the dividend. Okay. Let's see. Questions about that dividends received deduction? That's a new one. That's a completely new concept. So there are some special rules with regard to organizational expenses and startup expenses. First off, those are two separate types of expenses. And when you start up a company, oftentimes you have, you're going to incur expenses and have no income. So what they allow you to do is take up to $5,000 of those startup expenses. So startup expenses would be things like, you're purchasing supplies, you're purchasing, I don't know, you're paying rent, things like that. Startup expenses. Organizational expenses are, you paid an attorney to organize your company. So organizational expenses have to do with the actual organization putting together the company. Startup expenses are those initial expenses before you've actually started making any money. So you get to take up to whichever is lower. The lower of the amount of organizational expenses or $5,000. The rest of it you have to amortize over over a 15-year period. If the organizational expenses exceed $50,000, however, then that $5,000 is reduced to zero on a dollar-for-dollar basis. So once it gets, where is it? So once your organizational expenses get to $60,000, or I'm sorry, $55,000, then you don't get an immediate write-off. You still get the expense to deduct, but it's in the form of amortization, and it's spread out over 15 years. This is to prevent people from, you spend a whole bunch of money on these expenses, but then you never actually make any money in your business. Organizational expenses are treated the same. Enterprise's operating business expenses would be deductible as ordinary and necessary. However, the business is not yet active and not yet earning income. Therefore, they are not deductible at that point. You can't, until your business is active, you can't deduct any of that, any of those expenses, but you can amortize them. You can deduct up to that $5,000 once you start earning income. You still can't do it until you actually start earning income. Okay, so difference there between the organizational and startup expenses, and that $5,000 and the fact that the $5,000 is reduced dollar for dollar once it exceeds $50,000. Questions? No? All right. Let's see here. Let's see was in the process. Okay, so a couple more things here to mention. So corporate tax rates, this one's really easy. It's a flat 21%. 21%. And I guarantee you there is a question on the exam about that. So get that in your head. 21%. It's just a flat, there's no marginal tax brackets for corporations. It's just that flat 21%. So this part is easy. This was implemented in 2017 with the new Tax Act. Estimated payments. So corporations do have to make estimated payments. They are required to make 100% of the tax due for the year or 100% of the tax due for the prior year. For installments, again, it's going to be based on their fiscal year. 15th day of the 4th, 6th, 9th, and 12th months of their fiscal year. Okay. Fourth, so again, it's not really quarterly because the 4th and the 6th, that's 2 months in between. And 9th and 12th, well, I guess that's 3 months. But 12th and 4th is 4 months in between. So they are required to make those payments. Net operating losses. Okay, so what the heck is a net operating loss? So this is when a corporate entity has negative taxable income for the year. So that means, let's go back to our tax return. We have a negative number here. No income. All right, so there were some changes with the implementation of the CARES Act. NOLs, it's called an NOL, net operating loss, NOL. NOLs generated beginning on or before December 31st, 2017, carry back 2 years and carry forward 20 years. That means that we're going to amend our tax return again if we go back with it. It can offset earlier income. Okay. You can also waive the carryback period and only carry it forward. Okay. So you do have the choice of doing that. That's if the NOL was on or before December 31st, 2017. NOLs generated 2018, 2019, 2020 can be carried back 5 years and then forward indefinitely. Okay, so there are some differences here depending upon when the NOL was generated. A corporation, again, can elect to waive the carryback period and only carry it forward. These NOLs can offset up to 100% of taxable income in 2020 and before, 80% of taxable income after 2020. This gets kind of complicated here. NOLs that are generated in 2021 or later, there is no carryback. They can be carried forward indefinitely, but they can only offset up to 80% of taxable income. So that means, let's just say this was in 2021. I'm not going to carry it back, but next year I've got $20,000 of, I've got, what do I want to say here? I think my math. Let's say I've got $10,000 of taxable income next year. I can't offset all of that $10,000. I can only offset 80,000 of it. I'm sorry, 8,000 of it. And then the other 2,000 is going to go to the next year. Okay. So the carryback is applied first to the oldest year, then any remainder is applied to the second year, and so forth. This again can get a little bit confusing. Here we've got Wilson Company, formed in 2015. They earned $10,000 in 2015, $15,000 in 2016, 2017. They had an NOL of $12,000. Okay, so when you're looking at problems like this, you have to determine, okay, what year was the NOL, did we have the NOL? And then we'll look at the rules. Okay, so this was in 2017. This was generated on or before 2017. We can carry back 2 years. Okay, so NOL of 12,000, we'll offset that 10,000. And can we do 100% of it? I believe we can do 100% of it. So we will offset that 10,000 from 2015, and then the remaining $2,000 in 2016. There. Same information, but Wilson affirmatively elects to waive the carryback period. Prior to consideration of any NOL, they earned $8,000 in 2018, $21,000 in 2019. So again, it's a 2017 NOL. So they would apply $8,000, zero income for 2018. In 2019, they'd have $4,000 left to apply to the $21,000. Okay. Now we've got Xavier Corporation, formed in 2017. They earned $50,000 that year. They earned $5,000 in 2018 and again in 2019. In 2020, they recorded an NOL. Let's get the spreadsheet out again here. This may help. So we've got, here's Xavier. So we've got 2017, net income of $50,000. 2018, 5,000. 2019, 5,000. 2020, NOL of 75,000. Okay, so let's look at the rules here. So this was generated in 2020. Carry back 5 years and then forward indefinitely 100% of taxable income in 2020 and before, and offset 80% after 2020. Okay, so get this back here. We can offset 50,000. Whoops. So we took up 50,000 of that. 5,000. Over 5,000 of that. Another 5,000. So we are left with here $15,000 NOL that we can carry forward, right? So there's our carry forward of 15,000. Now let's continue on using the same information. Assume that Xavier earned 16,000 in 2021, right? Come on. Okay. 2021, 16,000. So we can apply 80% of that 15,000. So times 0.8 equals 0.8 times negative. So we can subtract up to 12,800, which means we've got, oops, $2,200 left over to use in 2022. Okay. So this is what we've got remaining. that we can use here in 2022, but it can only absorb up to 80% of our net income. All right, so when you're doing those NOL problems, make sure you reference what the rules are for the year in which the NOL took place. That's what's relevant. Not the year that you're using it, but the year that it took place, that you actually incurred it. Questions?